everybody just seems to be stuck when it comes to housing. But I have a question, and it's obviously the topic of today's episode. What if I could tell you a way where you even now could participate in finding a property that still has interest rates at 2% and 3% and 4%? If that were the case, would you be more willing to sell your home at your current rates because now you have the opportunity to find a home with similar mortgage interest rates? Or conversely, would you be more willing to buy into a property if you knew that you could get a rate comparable to what we saw in 2020 and 2021 and the like? It would probably free up a lot of you to be more willing to participate in the housing market. And while I would never say that this process is easy, we're going to talk through the complexities of it in this episode. There is a way to secure interest rates at those 2020 rates, and it comes through something called an assumable mortgage. And to understand the concept of an assumable mortgage, let's first walk through what it typically looks like when someone buys or sells a home. Let's say that I have a property and that property is worth $300,000 and I have a $200,000 mortgage on that property. So in this example, I have $100,000 worth of equity. It's worth $300,000, but I only owe $200,000. Well, in a typical or conventional home sale, what would happen is someone would come and they would put an offer on that property for $300,000. They would deal with their lender to secure a loan for whatever's needed to pay me what's owed on that property in full. And before we close, the title company would reach out to the lender that holds my $200,000 mortgage, and they would say, what is the total payoff amount for this property? So in this example, it's not going to be just $200,000. They may say the total payoff is $202,796. So at closing, the person who's buying the home would sign on the dotted line, and that $300,000 would be transferred to my account, not in full, but it would be transferred after they had paid off the lender that holds my current mortgage. So instead of getting a check for $300,000, I'm going to get my check for whatever $300,000 is minus what was sent to that lender. I walk away from that property free and clear. I have my equity in hand. That's how it usually works with a conventional process. With an assumable mortgage, however, instead of my mortgage being paid off, the person who's buying the home is going to assume that loan from me. They're going to take it over, and instead of paying it off, they're going to continue with the payments as I was currently making them. So in our example, instead of the conventional process where my equity is given to me at closing and what's needed to pay off the loan is sent to the lender, I'm going to get my equity at closing, but the person who bought the home will continue on with that mortgage payment instead of paying the loan off in full. Now, if you're keeping up with the math of the example that I used, a $300,000 home on which I owe $200,000, the person who buys the home from me is assuming a $200,000 loan. You're probably wondering, okay, well, what about the extra $100,000? Where is that money coming from? Does the person have to give me that money in cash? How do I actually get cashed out on the equity that I have on the property? Well, the answer to that is something called a second mortgage. And a second mortgage is exactly what it sounds like. It's a mortgage that you're placing on a property on which there is already a mortgage. And while that $200,000 mortgage in our example is going to be at those lower rates that you desire, the second mortgage is going to be at rates that are based on current market prices. So you might have the assumed loan that's at 2, 3, 4%. But that second loan may be at 6, 7, 8%, and you're left with what's called a blended rate for the two loans in totality. And you have to do a calculation of how much you're saving through the assumptions process